Lesson 9, Sideways Movement, Consolidation, and Fundamental Announcements. Before we get started, I'd like to point out a couple things. In the bottom center, you will see a number. That is the number of slide that I will be on during this presentation. That number matches up the number in your workbook. If by chance you end up getting lost, all you have to do is look at the number in your workbook and the number on the slide, match the two up, and then you should be caught up. The other thing I'd like to point out is up in the top left-hand corner, there is a sign called Important Information. I have posted that sign on what I consider to be very important information on certain slides during this presentation. You may want to earmark those pages and go back and really study and perhaps even memorize the contents on that page. It will help you tremendously in your trading. There are 16 lessons on trading the Forex to help you. These lessons are also applicable in other markets because they focus in on technical analysis. Successful traders will do what unsuccessful traders can't and won't do. I commend you on taking the time to educate yourself on how to trade before you trade. Successful people have a tendency to properly educate themselves before they get involved with anything. Successful people are very different than unsuccessful people. Successful people have created a habit of being successful, just as unsuccessful people many times create a habit of being unsuccessful. Do not underestimate this statement, and if you will, try to apply this statement to many aspects of your life, stating successful people will do what unsuccessful people can't and won't do. When you're challenged with making a decision, ask yourself, what decision would a successful person make? When it's time to place a trade, ask yourself this, what decision would a successful trader make? The 21-day 3% rule states this, the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. If you play this lesson once and just shelve it, chances are after about 21 days, you will only retain 3% of all the information from this lesson. If you study to become a trader, but then you go into the market and you start trading, but you have shelved all the information you have been taught for more than a month, chances are you will be operating at only 3% of the necessary information that you need to be a successful trader. Market Traders Institute and Forex.com want you to start trading maintaining 85 to 95% recall. Because of this, I admonish you to please play these lessons over and over again to where it'll help improve your percentages as a trader. By the end of this lesson, you will learn to find consolidation and recognize sideways movement. You will learn where to look for a fundamental announcement on the currencies. You will learn how to straddle consolidation, and you will learn what the term straddle means. You will learn how to avoid bull traps and bear traps. You will learn to place a straddle trade 15 minutes prior to the fundamental announcement. You will learn how to create a straddle trading plan and trade that plan. And you will learn where to place your protective stop loss orders and financially protect yourself in every trade. Before we get started, I'd like to do a quick review on the trading charts and placing orders. We are watching Japanese candlesticks. You can watch a line chart. You can watch a bar chart. I find Japanese candlesticks to be a little more user-friendly. They are applicable on all time periods. They monitor the open, the high, the low, and the close of any time period. There are bullish and bearish candlesticks. Bullish candlesticks close higher than they open, meaning the market is going up or rallying, and bearish candlesticks close lower than they open, meaning the market is dipping or reacting, falling. And the lines on each end are called wicks. They monitor the high or low of that time period. Let's look at this chart. See how when the market rallies, you have white bullish candles, and when the market dips and falls, you have black candles. You can also see that they have lines on each end. Those represent the high and low of that time period. Other important information, here's that sign, is that we watch bid charts. Most traders watch bid charts. There is a bid and an ask price at all times when it comes to trading. The ask price is usually higher. In the currencies, there is a 3 to perhaps 10 pip spread between the bid and the ask. This chart, or the charts that we are looking at, are going to monitor the bid price. The ask price will look identical to the bid price, except that it will be 3 to 10 pips higher. As you trade, remember you buy on the ask and you sell on the bid. What does that mean? That means if you enter the market buying and you enter an order at the market, you have bought on the ask, which means if the current price is 107.30, that's the bid. The ask price would be 107.35, which means if you entered at the market, you were filled at 107.35. That's the number you were filled at if there's a 5 pip spread. Now, if you place your stop orders for protection down here, every buy needs 2 sells. Your protective sell stop will be on the bid, which means all the candle has to do is hit that and you will be filled because we sell on the bid. Conversely, if you place a limit order for profit, the bid price, which is the actual movement of these candles, will need to come up and hit that order. The ask price will hit it first, the bid price will hit it second. Conversely, if our entry is a sell, we sell on the bid, which means if I short the market right now and sell, I will be filled at 107.30, but I will be placing my protective buy stop on the ask, which means as this chart rallies up, the ask price will hit my stop order first, and I will be filled on the ask. Many traders get confused. They say, well, gee, the candles never hit it. And because the candles never hit it, my order should not have been filled. No, we are monitoring the bid price. And our buy stop is on the ask because we buy on the stop. Conversely, the bid chart, if we were selling, because we shorted the market, we placed our buy limit because we're buying on the ask. The candlestick would have to come through our order in order for us to be filled because the ask is always a higher price than the bid. Types of orders. Lesson 1 focuses in on the types of orders that we'll be using in detail, but we use a market order, a limit order, and a stop order. These are the predominant orders we use when trading currencies. Whenever we buy above the market, that is called a stop order. When we sell above the market, that's a limit order. When we buy below the market, that's a limit order. And we sell below the market, that's also called a limit order. Any order placed, if this is the current market, any order placed above the market will be called an open, working, unfilled order. Depending on whether you are buying or selling will determine whether it is a limit order or a stop order. If the order is a sell order up here, then it is a limit order. If it's a buy order, it is a stop order. Buy stop, buy limit. Your buy limit when you buy below the market, that is called a limit order. When you sell below the market, that is called a stop order. Any order placed below the market is called an open, working, unfilled order. Therefore, if you place a buy order below the market, that's a buy limit. If you place a sell order below the market, that's called a sell stop. Please understand this to avoid confusion as your orders are filled. Ordering rules, just quickly, important information. Whenever you buy, you should have two sells, one for profit, one for loss. Even if you are canceling and replacing, you may want to place a sell order way up there, kind of like a wish list. Boy, if the market rallies and goes 300 pips, even though I'm going to cancel, replace, and lock in profit along the way, if it hits that order, I'd be very satisfied. Every buy should have two sells. Here you go. Market breaks a trend line, enters into the buy zone, which is less than 6. Our buy entry has two sells. It has a sell stop loss order and a sell limit order for profit. Conversely, whenever we place a sell, we need two buys. When we sell, our position is short. We are bears. We want the market to dip, come down. We buy then at a lower price for profit. We sell at we buy at a higher price for loss. Every sell should have two buys. Let's look at this sell. This sell entry has a buy stop loss order at the last high and a buy limit order for profit. Every sell should have two buys. OCO, the term OCO means whenever you enter the market, whenever you place your limit or your stop order or both, you attach them to your entry order, and if the market hits your limit order first, it'll cancel your stop order. If it hits your stop order first, it'll cancel your limit order. One cancels the other. When canceling and replacing, please keep in mind, only cancel or replace to the new last low after the market has made a new high. Meaning if this is your entry and the market's rallying, see how it retraces back? After it rallies one more time and makes a new high, now that we've made a new high, you can bring your stop order from the last low to now the new low. Now that the market rallies, makes a new high, retraces back, bounces at perhaps a Fibonacci number, a trend line number. As it rallies, making a new high, you see how it's taking out the old high, making a new high. As it is establishing a new high, you now can cancel, replace your order from the last low to now the new last low, which will be support. The exact same process takes place, only cancel and replace to the new last high after the market has made a new low as you sell the market. Bulls buy low first and sell high second. Doesn't matter what your methodology is. If you buy first, you are telling the world you are a bull and you will need to sell at a higher price to make a profit. Look at how this indicator provided 1, 2, 3 sells, which equated to 290 pips. At $10 a pip, that's $2,900 times, if you were to trade 10 lots, that would be $29,000. Bears want to sell first and buy second. Whenever you enter the market selling first, you are telling the world you want the market to turn bearish, you want the market to dip, you want the market to go down. You are involved in a hopeful bearish move. As the market starts to fall, you will come out buying second, therefore you will have bought low and sold high. Look at how we sold first, bought second, but we bought low and sold high. If you buy something at $104 and sell it for $107, did you make any money? Yes, you made $3. Look at how these two moves generated 350 pips. Many times you'll notice that the market falls faster than it rallies. And one of the reasons why the market falls faster than it rallies is because fear is a greater emotion than greed. And whenever you find a product a stock, a currency, whatever, as it devalues faster than it increases in value. That's why many times the devaluation of anything happens at a much more rapid rate than the increase in value. Keep that in mind. Technical traders learn to read charts. See, technical traders read charts like doctors read x-rays. Why? Because to the trained eye, these charts are telling a story. And the story they're telling is where the next probable move is going to be. Traders make money on forecasting the future, not so much on looking at the past. It's hard to make money saying, well, I should have got in here, should have got out there. We all can make lots of money doing that. We have to make a decision on where the market's going to go in the future. Because a chart is a chart is a chart, technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a chart, you will control or start to control your financial future in any market. A quick review on support and resistance will be very helpful for this lesson. Remember, we need to spot highs and latest levels of resistance and support. So a high is 2 candles to the left that are lower than the wick high and 2 candles to the right that are lower than the wick high. That'll constitute a high. However, not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. Let's look at a low. A low has 2 candles to the left that are higher than the center wick and 2 candles to the right that are higher than the center wick. That makes a low. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 really focuses in on this. If you have trouble with support and resistance, please review Lesson 2. But let's look at this. Your latest highs and your higher highs become your levels of resistance, and your latest lows and your lower lows become your levels of support. Do not underestimate the game between the bulls and the bears, as I focus in on that in Lesson 2. Understand that. It can help you tremendously in profit taking. A quick review on trends and trend lines will also be helpful for this lesson. Remember, there are swings inside of swings, which is Lesson 7, but the market is constantly on the move, going sideways, if not rallying, reacting, but they are creating little swings, highs and lows, highs and lows, highs and lows. But they also create one big swing. As I focus in on this on Lesson 7, it can become very helpful. Look at this chart. Low to high is an upswing, high to low is a downswing. Low to high is an upswing, high to low is a downswing. Look at how the market moves in swings. But not only does it move in swings, little swings, it creates one big upswing. Now, uptrends are nothing more than swings that are making higher highs and higher lows. Let's look at this chart. Market is making higher highs, 2 to the left, 2 to the right. This high is higher than that high, this high is higher than that high, and higher lows. This low, 2 to the left, 2 to the right, is higher than that low, and this low is higher than that low. That is an uptrend. Higher highs and higher lows. When you spot an uptrend, you will draw your trend lines across the lows of support. Lesson 5 really focuses in on trend line trading. Look at how we drew the trend line in an uptrend across the lows of support. Now, there are three primary upward trend lines. There's an inner, outer, and a long term. Downtrends work the same way, but in the opposite directions. Downtrends create lower lows and lower highs. Look at how the market is making lower lows and lower highs. Whenever the market's making lower lows and lower highs, it is a downtrend. If you spot a downtrend, you will draw your trend line across the highs of resistance. Look at how we draw them across the highs of resistance. Once again, Lesson 5 really focuses in on teaching you how to draw your inner, outer, and long-term trend line. And because the market is constantly trending, if it's not going sideways, look at how it's slowly trending up, then aggressively trends up, then slows down, then reverses, forms a crown, which is Lesson 8 and then starts to fall and then crowns again and turns around and rallies again. Look at how it downtrended, uptrended. Lesson 5 really focuses in on that. Let's look at this chart. Rallies up, reacts, rallies up, makes a huge swing inside a bunch of small swings, and a large uptrend inside an uptrend, downtrend, and an uptrend. Lesson 9, sideways movement, consolidation, and fundamental announcements. Now I find this lesson to be a fun lesson. Understanding how consolidation works can really become profitable to the trader. The best way to understand what you've learned is to write down what you think you know about consolidation and then go back after you've been taught and look at what you thought you knew versus what you now know. Your perception is your reality. My perception is my reality. These lessons are about transferring my perception of how the market works to your perception of how the market works and creating an accurate perception of how the market works to where you can take advantage of price movement in the market. Write down what you think you know about consolidation, sideways movement, bracketing. Pause your machine. This is an Euro 1 hour chart. Consolidation works on all time periods. This is a Euro-Yen cross. This is a 4-hour chart. Fine. Consolidation, bracketing, sideways movement on this chart. Pause your machine. This is a Euro 15-minute chart. Fine consolidation, bracketing, sideways movement on this chart. Pause your machine. This is a Euro-Yen cross, 4-hour chart. Fine consolidation, bracketing, or sideways movement on this chart. Pause your machine. This is a British pound 30-minute chart. Pause your machine. Okay, the market is constantly on the move. The Forex is constantly on the move. It is going up, down, or sideways. Constantly. Let's look at it. Sometimes it's going real slow, calms down, and then all of a sudden it starts to turn real aggressive. Look at this chart. You will learn about pennants, and pennants. This is what's called a diamond pennant. You'll learn about that in our lesson on pennants. It's very, very informative, and trading pennants is very, very productive as well. Pennants can be found in lesson 15, trading pennants. But the definition of accumulation, consolidation, bracketing, or sideways movement is this: when prices establish a tight trading range, creating somewhat equal levels of support and resistance. Now let's look at this. This is accumulation, consolidation, bracketing, sideways movement. See how the market starts to create a clear line of resistance and a clear line of support, and the market has a tendency to bounce off of those levels of support and resistance and stay within what's called a trading channel. Now let's look at this chart. See how the market came down, bounced, rallied up, bounced at resistance, came back down to support, bounced, rallied up, didn't quite make it to resistance, came down, bounced again, formed a tweezer bottom. Boy, there's a great lesson on trading Japanese candlesticks, lesson number 11, that can teach you how to trade these signs, Japanese candlesticks, as well as lesson number 15, which also talks about trading inside of sideways movement, which we'll discuss here as well. But look at how it rallies up, hits resistance, bounces again, comes up, hits it again, bounces, comes down and bounces again. Now accumulation, consolidation, and bracketing on the Forex is this: When prices establish a tight trading range, creating trading ranges of equal levels of support and resistance between 20 and 60 pips over a 6-hour or more time period. This consolidation usually takes place right before a major breakout. Look at this consolidation. This is 15 hours of consolidation. Look at how the market just kind of calmed down, went sideways. Each one of these candles is 15 minutes, but for 15 hours it went sideways before it broke out and started to rally. Now, markets accumulate, consolidate, and bracket for two main reasons. One, prices have reached the value that traders are willing to pay for that product, not any more and not any less. The second reason is traders are not trading because they are waiting for a fundamental announcement to take place. Now let's discuss this word trading ranges. Trading range is the difference between the high and the low of a time period or a trading period. For example, a day. A trading session can create a trading range. The market can create two different trading ranges all on the same chart. The trading range of consolidation and the trading range of the chart. Let's look at this chart. Here is the trading range of the whole chart. That's the high to the low of the chart. See the low? That's the lowest low of this chart to the highest high of this chart. That's the trading range. Now, look at how we have a consolidation, and in that consolidation we have another trading range. It's a smaller trading range inside a larger trading range. 14 hours of consolidation and a tight trading range are inside the trading range of the chart. Now, fundamental announcements or reports are this. A country is nothing more than a large corporation. Countries produce products. Countries usually have a leader, like a corporation does. Countries usually have a structure, like a company does. Companies, as they sell products, they have receivables where they sell it and people owe them money. Countries are no different. And companies produce reports that talk about their overall health and well-being, their financial health, so that the world can determine whether or not the company is surviving, whether it's making money or whether it's losing money. Countries do the same thing. There are approximately 14 reports produced in a country that account for the profit or loss of the country. These reports are called fundamental announcements. Each market has its own fundamental announcement. Now, there's 3 trading sessions every 24 hours. The Forex opens approximately at 7 p.m. Eastern Standard Time on Sunday evening and closes at approximately 4 p.m. Eastern Standard Time on Friday. Every 24 hours, there's 3 trading sessions. Asia opens up at 7 p.m. and closes at 6 a.m. Eastern Standard Time. Europe opens up at 2 a.m. and closes at 11 a.m. Eastern Standard Time. You can see that Europe and Asia overlap each other. Asia consists of Hong Kong, China, Taiwan, Japan, Korea, all the way down to the Polynesian Islands into New Zealand and Australia. Those are the Asian markets that open up at approximately 7 p.m. and close at 6 a.m. Europe is all of England, Germany, France, Switzerland. All those European countries constitute Europe. Europe and Asia are open at the same time, and of course, U.S. starts at Canada, comes down the United States, Central America, and all of South America. It opens up at approximately 8 a.m. and closes at approximately 5 p.m. Eastern Standard Time. You can see that Europe and Europe and U.S. overlap by 3 hours in the morning, from 8 a.m. till 11 a.m. Now, ForexTips.com monitors the fundamental announcements throughout the world. And we post those announcements on a website. Now, fundamental announcements, which talk about the overall financial health and well-being of a company or country, have the ability to shift the value of that company or country. And fundamental announcements shift the value of the economy when it comes to currency trading and are the main reasons for price change and breakouts, which can create large price swings and trading ranges. ForexTips.com, which I will be showing you, posts all the fundamental announcements from the major world powers. Now, to find this, you will go to ForexTips.com, very easy, and then you'll go to the members login. As you become part of ForexTips.com and Market Traders, you'll acquire a password that will allow you to monitor the fundamental announcements. As you go into the website, you will see all the fundamental announcements for the United States, Europe, Japan, Asia. We post them, and we also post what the previous was and what a forecast is, the time they're posted and the date. We post these every Sunday night for the new upcoming week. Now, when traders spot consolidation, as a rule, they will start to anticipate a breakout. Now, a breakout is when prices break out of that sideways trading channel, that sideways pattern of accumulation, and break through either support or resistance. If the bulls take control, the market will start to rally and establish new highs. If the bears take control, the market will start to dip and establish new lows. Now, a breakout is when prices break out of that consolidated channel in either an upward or downward direction. Look at how the market went sideways, then finally it broke out of that channel, broke through the line of resistance. This is what breakouts look like on a chart. Now, this is an hour chart. Each one of these candles represent an hour, so there's roughly 24 candles per day, and this is what a breakout looks like whenever you see a trading channel. See, tight consolidation, then it breaks out. Tight consolidation, then it breaks out. Tight consolidation, then it breaks out. When traders spot consolidation or sideways movement, a trading opportunity may appear. That trading opportunity is called a straddle. Now, this is what a straddle is. A straddle is when a trader places an order a little above resistance to buy if the market breaks out to the north, and an order to sell below all the support just in case it breaks out to the south. Now, we place our order on currencies to buy 15 pips above resistance and 10 pips below support. The reason why 15 above and 10 below is because we are trading off of a bid chart. You must stay back away from the resistance and support as to not be taken in before the announcement. Now, let's look at this. Remember, at the beginning of this lesson, I pointed out that we are watching a bid chart. This is the bid, this is the ask, and that the ask price stays about 3 to 10 pips higher than the bid. Because of that, we don't want to place orders right at the levels of support or right at the levels of resistance. You don't want to do that, because as the market comes up and bounces, it could easily take you in, and before you know it, you are sitting inside this channel being bounced back and forth, not knowing what to do. Look at how the market can sometimes break out of a tight channel and it can shift its level of consolidation. I talk about this in detail in lesson 2, where past resistance becomes future support. See this level of support here? Look at how it was past resistance. Look at how the trading channel shifted. So as you straddled consolidation, make sure you stay 15 pips above those highs and 10 pips below those lows. If you spot consolidation or sideways movement, the first thing I want you to do is go to the economic calendar and see if there's a fundamental announcement. Second, check to see if the consolidation is within a 20 to 60 pip trading range. And third, check to see if it has gone sideways for at least 6 hours. Now, if consolidation meets that criteria, then and you have a fundamental announcement coming up, then place an order 15 pips above the resistance because of the bid chart and 10 pips below the support, once again because it's a bid chart, and do that 15 minutes before the anticipated breakout. Now see how I went above all this resistance and below the support with the actual order, so that when it broke out, the market took me in and I went with it. Now this is what consolidation looks like on a 1 hour chart. See how on a 15-minute chart it looks a little different and spread out than on a 1 hour chart. This is 14 hours of consolidation on a 1 hour chart. Now the breakout. That's when prices break out of that consolidation or trading channel in either an upward or a downward direction. See the breakout now on this chart? This is called the breakout. It's breaking out of this trading channel. This is a 40 pip trading range. Look at the breakout here. Believe it or not, this is a 60 pip trading range in here. Market broke out. When the market breaks out like this, obviously there was a fundamental announcement that shifted the value of the currency. Now, fundamental announcements create large trading ranges between 120 and 300 pips per trading session. Now, to understand why 120 all the way up to 300 pips per trading session, you really need to review lesson 14, which discusses beats. But fundamental announcements can also create great trading opportunities. Let's look at as we move forward. See how the market broke out of this trading channel and fell literally 180 pips as it broke out. 180 pip trading range. This lends itself to a lot of trading financial opportunity. This is shorting the market. We would enter the market selling at 8,600 and buying roughly at 8,500, or whatever your profit is you're going to go after. Look at this breakout from this trading range here. Market breaks out and look at how it rallies 100, 200, 300, 400 pips over a couple day period of time. This is called a breakout. 400 pip trading range. You can see them right here. Whenever you see these large candles, they represent trading ranges. They also, large trading ranges also represent a huge breakout. This is a 2 hour chart, which means every one of these candles represent 2 hours. You can see that on this day the market had moved 180 pips up, came back 120 pips. Look at on this day, rallied 100, 200, 300 pips. Here's consolidation on this 2 hour chart, and there's a nice 300 pip breakout from that consolidation. Now, if it breaks out to the south, your protective stop loss order will be at the last high. If that distance is too far and does not align with your equity management, then pass on the trade, whether it breaks out to the north or to the south. Now let's look at it. See how this breakout came to the south? Whenever you straddle, if the straddle is too great and you say, well, gee, you know, I have a level of consolidation, 120 pips consolidation, then you may want to pass on straddling because it does not lend itself to equity management. If it breaks out to the north, your protective stop loss order will be at the last low. If that distance is too far and does not align with your equity management, then pass on the trade. Once again, we have a straddle. If your consolidation is 120, 180 pips, that means that if it broke out to the north, your stop order would be at the last low, which may be 120 pips away. That may be too much risk. I say straddle consolidation when you have a 40 to 60 pip trading range. That way, as you add the 10 pips to the sell and 15 pips to the high, you're within a level of equity management so that whenever it breaks out, you can properly trade it. Now let's go through a trading exercise. Now that I've explained to you what consolidation is, find the trading opportunity here on this chart. Draw your lines on this chart and draw where you would straddle in anticipation of a breakout. Pause your machine. This is what it should look like. See how you place a buy and a sell right above the consolidation? Now, find consolidation on this chart, place your straddle, pause your machine. This is what it should look like. Look at how the market broke out to the south, took you in. That's the straddle. Find consolidation on this chart. Pause your machine. This is what it should look like. There are two, obviously, levels of consolidation. This is a pennant, which I discussed in lesson 15. This is sideways consolidation. There's the breakout. There's obviously that breakout. Find consolidation on this chart. Draw your straddle lines of your buy and your sell. Pause your machine. This is what it should look like. Now, when straddling, if the distance between the high and the low is too far and does not lend itself to your equity management, you may want to pass on the straddle trade. I've pointed this out several times because I can't overemphasize the importance of equity management. If the risk is too great, look at this consolidation right here. Look at how this would literally be by the time you add 15 pips to the high and 10 pips to the low. We are roughly looking at about 120, maybe 100 pip spread, 120 pip spread. That may be too much risk, because if the market breaks out to the north, your stop order right here is going to have to be at this last low, which would literally be about 100 pips away. If it breaks out to the south, your stop order is going to have to be at the last high, which is literally going to be 100 pips away. Too much risk. I discussed risk management and equity management in lesson 3. Please understand it before you trade. Every trader's focus is survival. Now, let's walk through this trading exercise here. Let's trade consolidation. As we trade consolidation, Market Traders has come up with a piece of software that allows people to paper trade. Boot up your trading software. As you boot up your trading software, make sure you are very familiar with it. We give all traders that we teach approximately $50,000 of monopoly money to allow you to trade and practice. Doctors operate on cadavers first. We want you to practice with monopoly money before you trade with real money. Become used to the methodologies before you trade. Let's face the facts. All of us as traders want the market to move in our direction from entry. Education on how the market works can improve those percentages. Let's watch what educating ourselves about consolidation can do for us. Now, before you enter the market, make sure you're real clear on whether you're going to be a day trader or a position trader? Are you going to just trade this for 2 or 3 hours, or are you going to stay in for 2 or 3 days? Be clear before you trade. Now, if you enter the market wanting to cancel and replace as a day trader, here's an important information tip, then you may want to cancel and replace based on a 30-minute chart. Now remember, only cancel and replace to the new last low if it breaks out to the north after the market has made a new high. And you may take the time period down from a 2-hour chart, perhaps down to a 30-minute chart. The same thing on cancel and replacing as if the market breaks out to the south and you want to day trade and cancel replace as it makes new lows, do that on a 30-minute chart. Don't do it on a 2-hour chart. Exit trading strategy, make sure you're real clear on what you're going after. You need to decide whether you're going for 40 pips, 100 pips, 150 pips. Would you be satisfied if you made 150 pips? Or at $10 a pip, $1,500 a lot? Or are you going to cancel replace? Be very definite on all that. Please use logic when placing your limit orders to get out for profit. Keep in mind the financial game, which is lesson 2. Lesson 7, the Fibonacci numbers can participate greatly in teaching you where to get out. And of course, lesson 14, the harmonic beats and vibrations can participate in teaching you. Now, rules to straddling a trade. When you find consolidation in a tight trading range, 20 to 60 pips for at least 4 to 6 hours, go to forextips.com and find the anticipated fundamental announcement. If there is a fundamental announcement, find where all the latest levels of support and resistance are to determine where your buy and sell entries will go. Remember, we're buying 15 pips above those levels of resistance and 10 pips below those levels of support. And we want to place that order only 15 minutes before the announcement. Do not place the order before the announcement. Be in there, 10 minutes before. The reason I say 15 minutes because I want you to do some homework and I want you to understand exactly what you're doing before you trade. Now, if the potential stop loss order is too far away in the straddle and you can't afford the potential loss should the trade not work out, then stay out and do not trade. Pull out your trader's checklist, create your trading plan, and trade that plan. Now, once again, you're going to go to forextips.com. You're going to find the fundamental announcements that are going to allow the market to move in your direction. Keep in mind that monthly, quarterly, and yearly announcements move the market way more than weekly announcements. That is a trader's tip. Monthly, quarterly, yearly fundamental announcements have a tendency to make the market more volatile than weekly announcements. Now, if you turn on your chart, and this is what you see, this is the 30-minute chart, you start preparing your trade and start to do your homework, drawing trend lines, figuring out support and resistance, beats, etc. The fact of the matter is, none of this is really going to help you in straddling the market. We are straddling for entry because before the announcement or before the breakout, the fact is it really doesn't matter whether it breaks out to the north or breaks out to the south, because whether it breaks out to the north or south, it's going to take us in. The reason we want to do our homework and drawing our trend lines and figuring out where the levels of support and resistance are is to help us determine perhaps where to get out. Once again, lesson 2 really focuses in on the game. Go find all those levels of support and resistance. This would be the straddle. We would straddle 15 pips above the high and 10 pips below the low, 15 minutes before the announcement. Let's look at how we're sitting here with roughly a 60 pip trading range. Look at how the market has consolidated. Each candle is 30 minutes. This is consolidated for quite some time. Now, a trader's mantra. Here's another fact. You may think you know which way it's going to break out, but the fact of the matter is no one really knows which way the market's going to break out. Because of that fact, a straddle is very productive. But you must buy into a trader's mantra, which is, I will educate myself on how the market works. I will learn how to find and trade and place a trade. I will trade with equity management. I will never trade without a protective stop loss. I will not chase the market. I will be patient. The market will meet the criteria of my trade, or I will not trade. Now, fill out all your paperwork. I like everyone to use trading forms as they paper trade, allowing them to keep track of everything that they're doing on paper, just in case your computer software crashes or you have some sort of electrical blackout. At least you know what you are doing and what your plan is. Fill out the date, the currency you're trading. Here is the form to straddle. The instructions on how to fill this out are in the back of your book. If you have any problems in using this form, please give our company a call. We'll gladly go over it with you. Now, here's another important trader's tip. The length of consolidation many times equals the distance of the breakout. For maximum profit taken, please refer to lesson 7 on Fibonacci's. But look at this trader's tip. See the length of consolidation? Many times when the market finally breaks out, that then becomes the distance of the breakout. Look at how the market rallied, topped out, and now it's starting to fall. Just a nice trader's tip. See, the length of time in the consolidation many times equals the distance of the breakout. See that? Market breaks out. That's the same distance as the length of consolidation. Now, when the market takes us in, which it now has, we straddled this, we're going to cancel our stop order from the buy stop that we had. We're going to now cancel that, and we're going to place a new stop order because the market took us in on a sell entry. So now that the market took us in, we're going to cancel our buy stop order for entry and now make it a protective buy stop order for potential loss. And it will go at the last high. Here are your last highs. Okay? So now the market took us in. Cancel the buy stop, replace it with a new lower buy stop, which is the last high, now that the market has taken us in. You now need to fill out this form now that your trade's been set up. Put your buy here. Now we're selling, excuse me. So this would say sell. Every sell has 2 buys. Your price is here, the down arrow here. Set up your limit order for profit and your stop order for loss. Pause the machine and fill this out if you need to. Now that you've decided whether to go for 40 pips, 60 pips, 100 pips, whatever your reasoning is, here if you went for 40 pips, because these are 30-minute charts, you are literally in this trade from time of entry, 30 minutes, 1 hour, hour and a half, you are filled. If you went for 100 pips, you were in this trade 1 hour, 2 hours, 3, 4, 5, 6, 7, 8, 9 hours to go for 100 pips. If you decided to go for 150 pips, you were in for almost 15 hours, and obviously if you're canceling or replacing, you've turned down to a 30-minute chart. You would, as soon as the market made a low, which is right here, came back, you turned and made a new low, you would cancel replace from here to this high, to this high, to this high, to this high. You're still in the market as it continues to fall. Look at the game of the market taking out your levels of support and your levels, your first level of support, your second level of support. You would have all your levels of support filled out on your sheet as you trade. Once again, your trading software will monitor your P&L statement at the bottom, but fill out your P&L statement when you're done trading. Print out the copy of the chart at the top and keep this in your trader's book for reference so that you can go back and see what you have done. Now, if the market breaks out of consolidation and returns into consolidation, you will need to reverse your position at your protective stop and go with the market. Do not marry a trade. Be quick to turn from a bull to a bear or from a bear to a bull. Listen to the chart, and the chart will tell you which direction the market's going to go. Strategize several scenarios before you trade. Use the if-then approach. As you straddle, say to yourself, if the market breaks out to the north, then I'm doing this. If it breaks out to the south, then I'm doing this. If it breaks out to the north and returns into consolidation, then I'm going to do this. If it breaks out to the south and returns into consolidation, then I'm going to do this. Strategize several scenarios. Be clear in your head. Rehearse it before you trade so that you're not scrambling as the market's moving. Now look at how the market in this consolidation broke out to the north, took you in, came back into consolidation, crossed consolidation, broke out to the south. You've got to go with it. And when the market, now here's a rule. When the market breaks out of consolidation, U-turns, comes back in to consolidation and stops you out, that is a clear sign it's reversing and going the other way. Therefore, don't just get stopped out and throw a pity party. Reverse your position and go with it. So you lost a little money in here. Look at all the money you make up as it breaks out in the opposite direction. The reason why sometimes it'll break out to the north and then U-turn and come back is if there is a fundamental announcement that happens, like let's just say 8 o'clock, and another announcement happens at 8:30. One announcement may take the value of that currency north, where the other announcement may take it back to the south. So once again, quarterly, weekly, and monthly, quarterly, monthly, yearly announcements can have a tendency to move the market very strongly in a direction. Not all fundamental announcements move the market. Banks are considered fundamentalist traders. When a report is read, they aggressively start trading. That's where a lot of price movement comes from. If the announcement or report does not have a change in economic value for the currency, the market will not break out and will continue to move in the direction of the previous trend. If an announcement from a previous trading session moved the market to a new value and now the new announcement reflects its new value, it may not move again. Now let's look at this. The market was in a slow uptrend. There was a fundamental announcement that took place inside this consolidation. The market didn't move, and because it didn't move, it just slowly continued its uptrend movement. Usually, if a fundamental announcement does not move the market, then go back and look where the market has been. See how the market was in an uptrend? Because where it has been will usually be where it will continue to go. See how it has been in an uptrend? It will continue its uptrend move if the fundamental announcement does not move the market. Trader's tip. If you spot consolidation and straddle the market, yet forget to check to see if there is any fundamental announcements, you'll probably get caught up in a bull or a bear trap. Now, this is what's called a false breakout. It is also called a bull trap. It is where there was consolidation, the market broke out of that consolidation, came back into consolidation, and continued in the direction that it was previously coming from. False breakouts and traps are due to no fundamental announcements and the market is doing nothing more than fulfilling a Fibonacci movement. Let's look at this. Market was in an uptrend. Market started to consolidate. Market broke out of consolidation, created a bull trap. The bulls let it come down out of that consolidation. Then it came back into consolidation. If you straddle the market and there's no fundamental announcement, don't be surprised if you get caught up in one of these traps. Bull traps are nothing more than the market moving in its natural, harmonic, vibratory Fibonacci fashion. Look at how the market broke out of this consolidation and did nothing more than retrace to a Fibonacci number, tweezer bottom, and then start to rally. The same will appear on a bear trap. False breakouts and traps are due to no fundamental announcements and the market fulfilling the Fibonacci numbers. See how it broke out and came in? Now look at how the market was in a downtrend. Consolidation takes place. Market breaks out of this consolidation. All it did was go to the 5-0 of this last swing, bounce, and continue in its previous direction. So, once again, no fundamental announcement, no straddling. Look at these bear traps. Market consolidates, breaks out, but then continues in its previous direction. Market consolidates, breaks out, continues in its previous direction. Those are called bear traps. Whiplashes are created when two fundamental announcements take place, one right after the other, that have opposite effects on the economy. Look at this whiplash. See, comes out, takes you in there, takes you in there. Look at this. Whiplashes. Takes you in there, takes you in there. Takes you in there, takes you in there if you straddle. Now, in a straddle whiplash, your buy and sell orders will both be filled and you will have automatically locked in a loss. That's the greatest part about straddling. The absolute worst thing that can happen is that you will lock in a loss. Whiplashes create locked in profits or locked in losses. See how the market rallied, took you in first, then come straight across, took you in second, and then came back into the center of consolidation. This is a whiplash. All it did was take you in on a buy and take you in on a sell. This was your protective loss stop anyway. You locked in that loss. To help you understand where to profit take as you straddle these, once again, refer to Lesson 2, Lesson 7, Lesson 10, and Lesson 16. Great lessons on how to profit take. If the swings are large enough, you can trade inside consolidation. What you will do is once you've established your clear line of resistance and your clear line of support, you'll want to sell every time the market comes up and hits that resistance. Then exit and reverse your position. So basically you'll be selling, buying, selling, buying, selling, buying. All these moves become your profit. Let's look at this. You buy, all this is profit. When it hits resistance, you sell. All this is profit. You buy, all this is profit. You may have stayed in this trade. Comes in, you sell here. Sell once again if you profit take. You can buy and sell if the trading ranges are large enough. Make sure you have a good, large trading range. Look at how this trading range was roughly 250 pip trading range. It lent itself to great financial profit to buy and sell the trading range. Look at, here's a 30-minute chart. See how old resistance becomes now new support, and we buy support, sell resistance, buy support, sell resistance, buy support, sell resistance. Buying and selling. Now where would your stops go? If we buy here, goes at the last low. Here's my protective loss stop. If we buy here, here's my protective loss stop. If we buy here, here's my protective loss stop. Goes at the last level of support. If we sell, we have to go find our level of resistance, our latest level of resistance. If we're selling here, our stop loss goes at the last high or level of resistance. Now remember, the best way to understand what you've learned is to write down what you think you know versus what you now know, and your perception was your reality. Here was the first chart. Pause the machine and go find and look at what you read or what you put about support and resistance. And consolidation, bracketing, sideways movements. Here's the first chart. Do you now see this? Do you now see how the market broke out, took you in, came across, stopped you out, but that a trading opportunity stayed, allowed you to reverse your position and take advantage of this move? Here was the Euro-Yen 4-hour cross. Do you see this consolidation? Each one of these candles is 4 hours. Look at how the market was 4, 8, 12, 16, 20 hours of consolidation, and then it finally breaks out. Look at this consolidation here, 4, 8 hours. Place those trades 15 minutes before consolidation. You may want to take your time period down to a 30-minute chart or a 15-minute chart. Let's look at this 15-minute chart. There's where your straddles would be. There's a bear trap. There was no fundamental announcement on this day. There's the straddle 15 minutes before the announcement, market breaks out. Let's look at this 4-hour chart. This is all consolidation. This is called a pennant. Once again, less than 15 kind of goes into that. 4 hours, here's 16 hours of consolidation again. Market breaks out. Nice breakout. Here's another 4, 8, 12 hours of consolidation. Market breaks out to the north. Here's British pound 30-minute. This is what it looks like. See how as the market moves, old resistance becomes future support? Now, once again, here's the rules to trading a straddle. Find that consolidation in a tight trading range. Place your orders 15 minutes before the breakout, 15 pips above the buy, above resistance, 10 pips below support. If the risk is too much, you may pass on the trade, pull out that trader's checklist, create a trading plan, and trade that plan. Now let's all agree, if you're going to be successful at trading, you've got to have an edge. You've got to educate yourself and know where to get in and why, and know where to get out and why. You've got to enter the markets. You can enter the markets by straddling on fundamental days where there's fundamental announcements. Let's all agree, if the risk is too great, you should stay out. Let's all agree that if there's no fundamental announcements and you straddle, you're probably going to get trapped in a bull or bear trap. Manage that risk as you trade. If the risk is too great, pass on the trade. Now, did this lesson teach you how to find consolidation and sideways movement? Where to look for fundamental announcements? How to straddle consolidation? How to avoid a bull or bear trap? How to place your straddle 15 minutes right before the fundamental announcement? Did this lesson teach you how to create a straddle trading plan and trade that plan, and where to place your protective stop loss orders, and how to financially protect yourself? If this lesson did not do these things, then replay this lesson until you understand what you need to do. If things still aren't clear, please feel free to give us a call. Please feel free to go into our chat room, because the reality is this: 90% of all novice traders fail and only 10% succeed. The 10% succeed because of a reason. The 10% succeed because of a reason. And the reason they succeed is because successful traders do what unsuccessful traders won't do. Successful traders make it very clear in their head what their trading methodologies are going to be and what their trading strategies need to be. There's two ways you can pay for your education. One, you can try to get lucky. But if you make money off of luck, it'll only be a matter of time that you'll become unlucky. The second way is mentorship. Doing exactly what you're doing. Educating yourself on how the market works before you get involved. It really is like buying a map to a gold mine. It shows you exactly where the money is and how to extract it. Now what you have to do is you have to form a clear habit a disciplined habit of extracting that gold. Every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. There's 16 lessons on trading the Forex to help you. These lessons are very, very profitable. They all come with trading exercises that allow you to practice and practice before you trade. Please buy into this trader's mantra. Educate yourself on how the market works. Learn how to find and place a trade. Trade with equity management. Never trade without a protective stop. Do not chase the market. Agree to be patient. And make sure the market meets the criteria of your trade or don't trade. And remember, if the chart is not clear at any time and doesn't visually make sense, when in doubt, stay out. Go into forextips.com. Go into our chat room. Ask our traders questions. But when in doubt, stay out. Because of the 21-day 3% rule, once again, please replay this lesson so that you are operating at 85 to 90% recall. And on behalf of everyone at Market Traders Institute Incorporated and forextips.com, I would like to commend you on investing in yourself and purchasing this lesson. Thank you.